All right, so the policies and the regulations that are going to be outlined in today's class are requirements of the IRS and the Commission. Some additional policies and procedures that you may have at your property, they could be set by management, the owner's additional programs like HUD, RD, Home, other state and federal funding programs, and it could be set by the syndicator. So if you're ever in question on anything, definitely check with the management company and see what programs and policies are set for your property. Okay, so when someone is going to get bonds on their property, the owner elects the minimum set aside at bond closing. It's an irrevocable choice, and it must be maintained throughout the term of the qualified project period. There's two set-asides. There's 20 at 50, which is 20% of the total units of the property must be no higher than 50% of the area median income. Or there's 40 at 60, which is 40% of the units of the property must be no higher than 60% of the area median income. And we have a poll.
Here's that polling question now. It's very difficult.
All right, so federal elections, are they revocable or are they irrevocable? It looks like the majority of the people have answered correctly. It's irrevocable. So once they choose an election, that election is with this property for the term of the qualified project period. All right, so for the bond, there's income set aside definitions. There's qualified resident, which is a Q, and it's 80% or below. There's project qualified resident, which is a PQ, and that's at 60% or below. And additional qualified residents, an AQ, which is 50% or below. And then there's specially qualified residents, SQ, and that's specified percentage below 50%. So you're going to want to refer to your regulatory agreement to confirm your project's correct set-asides. So let's look at a regulatory agreement. Regulatory agreements are about 20 pages, and they're the official document containing the minimum IRS and Washington state requirements specified to the property. It's recorded at the county recorder's office, and it is a covenant attachment or attached to the land for a specified time frame in most cases. So this is what the regulatory agreement looks like. When you see this stamp up here, something similar to that. It's not always that one. It depends on county and year and all that stuff. But usually that just means that it's been recorded. It will show you usually how many pages there are. It'll show you what date it was recorded and what county it was recorded in. And then in this regulatory agreement, you will find federal, state commitments, also the compliance period for the bond projects. This is the qualified project period. This begins the first day on which 10% of the units are occupied for new construction, meaning that if this is a newly built property at 10%, that's going to be the first day. And then the bond closing date is going to be for the acquisition rehab projects. And then the end of the ladder of, and it's the date which is 15 to 20 years after the date on which the 50% of the units are occupied. You're going to find that date in your regulatory agreement. And you're going to want to find out when, or make a note, when the 50% of your units are occupied by qualified residents, because that's when that date will start. And the first day on which there is no tax exempt private activity bonds issued is outstanding, meaning that if they've been paid off. And then the third one is the date when Section 8 assistance is terminated from that property. So if you have a Section 8 contract with this property, Usually those are long-term, and usually you don't really terminate those. So this regulatory agreement could follow that property for quite some time. Is there any questions? All right, so when bond closing happens, this project description usually goes out to the owner. And from this project description, you're going to be able to find some pertinent information. This way you don't have to go through your regulatory agreement and search for all of these answers. You can find your OID number for the project. You're going to find the project name just to make sure you're on the proper property. And then you're going to find the bond closing date, and then the term of the regulatory agreement. And then you're going to find out if this is new construction or rehab. All of those you're going to be able to use to find out when your regulatory agreement could possibly expire. Then this also goes into the units of the project. The total units, it breaks it down for 1 bedroom, 2 bedroom, and it also shows common area units. The federal election is found here as well. Is it a 40 at 60 or a 20 at 50? And then the compliance monitoring requirements. For instance, this property has 39 units at 60% of area median income. All right, I will give it just a minute to see if there's any questions on this. So bonds can be mixed with tax credits. It usually starts out as a bond property, and then it takes on tax credits not long after. So usually when the project is being discussed, it's already in motion that they're going to go from bond to tax credit. So it's not like the bonds have been in service for 10 years and then all of a sudden they add tax credits to it. So they're pretty much hand in hand. So with the bond and tax credit, you're going to have 2 regulatory agreements. You're going to have the bond regulatory agreement, and you're also going to have the tax credit regulatory agreement. They could have different set-asides. Usually like the 40 at 60, that would be the same with both, but there could be state set-asides that are on there that are different. So you're going to comply with the most restrictive over both of those. So when you're doing your lease up and you know that you're going to be, it's bonds right now, but you know you're moving to tax credit, you're going to want to make sure you're restricting the rent as well. So definitely go to our income and rent limits and make sure you're not going to overcharge on the rent for the applicable AMI. And then there could be other set-asides. There could be other state set-asides that are going to be on the tax credit property or tax credit regulatory agreement. So you'll definitely want to make sure to talk with your ownership and find that information out. And if you have tax credits with your property, we highly suggest that you come to our tax credit workshop to be able to talk about or be able to learn about other things that are not a bond requirement. We do overlap on quite a few things, but there are quite a few differences between the 2 programs. So the physical requirements of set-aside units. Substantially, they need to have the same equipment and amenities. If there's a fireplace, that's a luxury, so that could be a little bit different, but you want to make sure that all of the units are pretty much the same and also the same size. You don't want to house all the market units as the bigger units and all of the bond units as smaller ones. That's not how the bond program is supposed to work. And they cannot be geographically segregated either. So basically, you're going to want to make sure all the units are mixed throughout. Okay, so initial move-ins. So the residents of set-aside units must be income qualified before they move in. So you need to make sure all of your paperwork is completed and signed by the resident before you hand them the keys. And income verifications must be dated within 120 days prior to the move-in date. We will be going over a lot of these later on in the program as well. So. income limits. So we use HUD income limits for each county. And you can find those at this, the website located here, or you could also go to our website, like I showed you earlier, the income and rent limits on our website. So many counties have multiple limit charts, and they're also based on the property's 42M letter or the bond closing date, whichever they chose where they want to get the income limit started at. So those are two main pieces that you're going to need to know. And the current applicable limit chart can be searched by property. I would highly suggest doing that rather than just going to the county. And nowadays, there's only one income limit per county most of the time, but a couple of years ago, there used to be multiple. So you definitely, your best bet is just to go and find your property and then go from there. And we're going to walk through that here in just a minute. And you're going to only want to use the commission provided income tables in effect at the time of the initial occupancy or the recertification for bond limits. And then rent restrictions are not required unless restrictions are outlined in the regulatory agreement. And Section 8 housing assistance payments are generally not considered rent. Or yes. So to be able to find your income limits, you go back, this is our website. Once you click on the income and rent limits, this is the page that would come up. Search income and rent limits by the property name. You can click on that box and it'll bring you to, we'll see in just a moment. And then you can click on the full list of the 2020 limits by county. And then if you need historical limits, you can come here and click there, and anything prior to this year's you will find in that link. So let's take a little journey. We're going to go into search income limits and rent limits by the property. So when you click on that, a downloadable PDF file is going to come up and download onto your computer. It's basically a spreadsheet, and it shows the OID number, the project name, the site name if it happens to be different, the address of the property, city and county, and what kind of compliance type it is, if it's tax credit or if it's just a straight bond property. And then bond closing date. So for instance, you see this one, it says tax credit, but it has a bond closing date. That means it's a combo deal. And then this one down here is just a bond. So it just has the bond closing date. And then it also has the placed in service if it's a tax credit property. And then over here, it shows you what income limit chart you need to go to. So the first thing you want to do is you want to locate the property or locate your property. And for instance, in this one, we're going to look at the 3904 MLK Way. And then you're going to go over to the, find the link for the applicable chart. And so that's going to be the 2020 MTSP King County. And once you click on that, it's going to now open up the income limits for King County. The top part is the income limits per household. And then over on the side, this is the set aside. So the bottom part is for the rents. So in the bond program, you normally don't need to know that. But if you do have tax credits coming on, that is something you're going to want to familiarize yourself with. So for instance, say you have 60% units at your property and a one-person household, their income limit would be $46,500. So say you have 40% set aside units at your property as well. And as you see, that one is $31,000. So you're really going to want to make sure that the resident that's moved in does not go over that maximum income amount. Is there any questions? And we have a polling.
Here we go. Poll number 5 for the day. Tax credit income limits are the same limits that are used for tax exempt bond projects. True, false, or I don't know?
The answer is true. Tax exempt bond projects have no rent limits, but are subject to income limits at 50, 60, and 80 MI. and the applicable limits are posted on the Commission's website.
Where can I go to find the income limits for a 9 or 10-person household? Got HUD 4350. You can look in your regulatory agreement, or you can go to this website.
Our tax credit income rent limits may be found on our website. The base for a household of 4 is 100% of the area median income. This base number is then adjusted up 8% for each additional household member. So the figure for 8 is 132% of the area median income. 9-person household is 140% of the area median income. And 10 is 148% of the area median income. And we also gave that sheet to you in your reference folder. It's called Household Size Adjustments. So now we're going to talk about calculating income. So there's different types of income. We have earned income, for instance, your job. Unearned income, Social Security, unemployment. And then there's also income from assets that you have, your savings account. And you add all those together, and that's what's gonna, that's how we're gonna get your gross annual income. So all amounts, monetary or not, that go to or are received on behalf of the household, even if the household member is temporarily absent. So say you have a married couple and the wife is in the military and she is, she's deployed. She's still part of the household, so you're still gonna count her income. And so all amounts anticipated to be received from a source outside the household during the next 12-month period following the certification date. So meaning money that you know that someone's going to be giving you. For instance, you have a younger household and the father pays her gas for her vehicle. She knows that her father's going to give her $100 a month for gas. That's a gift. So she knows it's going to happen. So that's what she's going to fill out a gift income because it's anticipated. So amounts derived from assets to which any member of the household has access. So for instance, your savings account, any of the, your checking account, things like that, that you have full access of. And then you're always going to use the gross income except for when you're counting self-employment. We are going to go into detail on a lot of these, so please stay tuned. And sporadic income is undeterminable, not expected, and not consistent. So you're not going to count that as income. So for instance, someone won the lottery and they took the one lump sum. We're not going to count that because we didn't know that they were going to win. They didn't know that they were going to win it. And they got it as a one lump sum. So if it was periodic, meaning that it was consistent, expected, and verifiable, so that same person that won the lotto, instead of taking a lump sum, they wanted to have it on a monthly basis, you're going to count that because now it's predicted, it's consistent, you know that it's coming. Annual income includes work, employment, self-employment, student financial assistance, and that's only on Section 8 recipients, military pay, Social Security and other benefits, periodic allowances, child support, alimony, gifts, family, friends support, TANF, which is welfare assistance, workers' comp, payments in lieu of earnings, unemployment. You've got retirement, pension, annuities, other monetary or non-monetary sources. For instance, there's that gas again. And then income from assets. Say you have a Venmo account that's collecting interest, or you have a savings account in the bank and it's collecting interest. We're going to move on and we're going to decide what income do I count. So for the head of the household, you're going to count their earned income and their unearned income. And that'll be the same for the spouse of the head, any other co-heads that are 18 or older, other adults, and for dependents, children under 18. You're not going to count their earned income, but you will count their unearned income. So for instance, Social Security, SSI. Full-time students 18 and over, you're going to count their earned income of a full-time student 18 years or older who is a dependent is excluded to the extent that exceeds $480. So full-time student is a key thing there, and 18 years and older. And if those two are met, then you're only going to count 480 of their earned income. If it's unearned income, you're going to count the full amount. Foster children under 18, you're not going to count their earned income, but you will count their unearned income. Sorry, I think I said that backwards. I'll say that again. Foster children under 18, you're not going to count their earned income, but you will count their unearned income. And non-members of the household, like a live-in aid, they're not part of the household, so you're not going to count their earned income or their unearned, because if they weren't needed as being an aid, they would not live in the household. All right, we're going to move on. You're going to want to verify all of the income directly with the third party. You're going to clarify any possible questions, and you're going to review for inconsistencies and ask questions. And if you find out the answers, please make sure that they're very clear on there, because when you send it to us, if you've had a question, you could pretty much guarantee that we're going to have that question as well. So you're going to want to be really thorough. When the employment verification comes back, if there's any empty areas, please clarify all of that. So you're going to want to plan ahead. You've got 120 days before this documentation is due. So please start early. You want to complete the documentation on time. You want to document your work. You want to prove how you calculated the data. Usually on the HEC, it's the third page, but if you have your own kind of document, Excel spreadsheet, whatever kind of document you have that you calculate the data on, you can send that instead of filling out the third page for the income. But you want to verify all the data, and you want to prevent any possible questions. So pretend you're going to court and you're having to prove your case. You want to complete your due diligence for each and every certification. And please never use whiteout or any other correction fluid to cover up any answer that wasn't supposed to be there. You don't want to scribble it out either. Just one line and the resident's initials next to it would be great. Please don't use highlighters on the forms. I know some people are wanting to make it a little easier for us, but yellow copy's okay, but when you use like the green or the blue, a lot of times that just creates a gray area and we can't read what's underneath that. Okay, so some of the required verification steps and accessibility. So for third-party written verification, we want to documentation or document verification attempts. So on the employment verification form up on the right-hand corner, there's 3 different lines, and next to it, it says first attempt, second attempt, and third attempt. Put the dates in there, and they must be attempted 3 times in a 2-week period. You don't want to attempt it when, Monday, Tuesday, and Wednesday and say, oh, they didn't get back to me. You need 2 full weeks. So maybe start on a Monday, resend it again on Thursday, and again the following week on a Tuesday. And give them some time, especially now during COVID. you know, things are a little slower than they used to be. So you're going to want to, when you're doing the documentation, you're going to want to put the date and the time and who you talked to. And the residents never can transport the third-party verification forms. It has to be from you to the third party. And then when it comes back, you're going to want to review for clarity and thoroughness. And if you need to get anything clarified, please use the income verification clarification by telephone. Then that way it explains everything to us, who you talked to, what the answers were. You want to clarify anything missing, illegible, or unclear facts. Again, if you have a question about it, you got to think we're going to have one too, or the next person who may be looking at that file. A known employer who will not third-party verify, you want to document and include that in the certification. We know a lot of people are, you know, you don't want to waste your time having to send it to a place that's not going to third-party verify. All right, so the third-party verbal verification or clarification, that's a form that we have, and document the verbal conversation. You're going to want to obtain the name of who you were speaking with, their position, and their contact information. You're going to put your name on it. You're going to sign it, date, and the time of the conversation. And you must back up this verbal verification with documentation. Is there any questions? All right, so second party document verification. So the resident must provide 6 consecutive documents with all pages. So for instance, if it's going to be their pay stubs, you want to make sure that there's no gap in the pay period, so they're consecutive. If there's something missing because maybe they didn't get, they had vacation or something and they didn't get paid for it and there was a lapse in a paycheck, you'll just want to make sure to note that for us so that we know why that one's missing. If it's a tax return, you must provide the full signed tax return or e-file confirmation. And then last but not least, first party verification. This is going to be directly from the resident. And this document, you're going to want it to be notarized. All right, so we're about 45 minutes in. I'm just trying to think of when we should take a break. I'll go a couple more slides. All right, so if you're using the work number to verify, you can Google work number and you can get an employer list. And then that way you know who uses the work number and you don't have to worry about sending in that verification form. You want to utilize the income verification clarification by telephone and obtain as much information as possible from the employer. At the very minimum, if you can get the applicant's start date of employment. I know that that's on the work number, but sometimes it's not 100%. Sometimes it might be off a little bit. So it's best if you can try to get that information from the employer themselves. And then you're going to want to document the use of the work number and that no additional information will be provided by the employer if this is applicable. And then you're going to check the accuracy of the printout by comparing it to at least one pay stub that is listed. So when, and I would definitely get the newest pay stub that they have and verify on the work number that every single dollar figure matches. And then in lieu of the work number, you can obtain the most current 6 consecutive pay stubs. We want 3 months. So we say 6 because we always think everyone gets paid twice a month. We know that that's not true all the time. So if they get paid monthly, you can get 3 pay stubs and so on, just as long as we get about 3 months. And from the pay stub and the start date, you can determine the resident's current pay rate and the year-to-date information. If the pay stub does not give you enough information to determine the year-to-date wages, you'll need to get a printout from the work number to figure out the year-to-date wages. And the cost can be passed down to the applicant. Another thing you can ask is if they could send you the first pay stub from the beginning of the year. And then that way you can find out the actual date. A lot of people always think that the first day of the year is the year-to-date start date. And a lot of times it's not. They actually work in December and they actually don't get paid till the following year. So you definitely want to double check and find out what year-to-date start date. We're going to talk about how to calculate the employment income. All right, so for full-time income calculation, for full-time hours is usually 2,080 hours in a year. So you're going to take their hourly wage times 2,080. And so for instance, this person makes $13.50 an hour times 2,080 equals 28,080. If they get paid weekly, you're going to take their weekly wage and times it times 52, as there's 52 weeks in a year. So for instance, this person makes 540 a week times 52 equals 28,080. And then someone who gets paid bi-weekly, meaning every other week, they have 26 pay cycles. So you're going to take their bi-weekly wage of 1,080 times 26, which will come up with 28,080. And if they're semi-monthly, meaning they're paid twice in a month, maybe the 15th and the 30th, you're going to take their, and there's only 24 pay cycles in a year for a semi-monthly. And you take their 1,080 times 24 and you'd come up with 25,920. Some people get the bi-weekly and the semi-monthly mixed up. But as you can see, there's 2 extra weeks in the bi-weekly. So if you were to base it on a semi-monthly, you would be putting their income under, and really they're making a little bit more money. All right, so the monthly wages or monthly, a person who gets their wages monthly, you're going to times that times 12. And that's pretty self-explanatory. So if they're less than full-time, you're going to take their hourly wages. So for instance, on the employment verification, it asks what their, how many hours they work in a week. And sometimes people put, you know, they might do just 32, or they might say between 30 and 35. We always use the higher of. So if you're going to take their hourly wages times how many hours in the week that they work, and you're going to times that times 52, because there's 52 weeks in a year. So for instance, this person that makes $13.50, they work 27 hours in a week times 52 weeks is 18,954. For someone who doesn't work a full year at a company, say that they might be closed during a couple of months a year, you're going to take how much their weekly wages times how many numbers of weeks they work in a year and times those, and you'll come up with their annual amount. Now you're going to want to find out what the difference is between how many work hour or how many work weeks they work in a year versus the 52 weeks. So for instance, this person doesn't work for 6 weeks. Well, what is that person doing during those 6 weeks? Are they getting unemployment? Are they going to live off of their savings account? You'll definitely want to make sure to note the file. So for annualizing their year-to-date income, you're going to want to take their year-to-date income and divide it by how many weeks are worked. And then you're going to take that and divide it by 52 weeks. So for instance, on our employment verification form, it asks for the year-to-date number, and then it asks from what day to what day that annual number was from. So for instance, in this example, they started on 1/1/17 and it ended on 7/12/17. So you're going to want to take those dates and figure out how many days or how many weeks. So for instance, with this one, there's 193 days, or there's 27.57 weeks. That was taking 193 days, dividing it by 7. So the 27.57, you do not want to round that up to 28. You can round it down, or you can use the exact amount, but never round it up. For instance, so this person, their annual wages was $13,080. So you're gonna divide it by the 27 weeks, and then you're gonna take that weekly amount and you're gonna times it times 52. So for instance, this person is going to make $25,494.11. Now, if you were to have rounded that up to 28 weeks, that would have equaled $24,291.43. Now you see there's a little bit of around $1,000 difference, and that can make that person over income. So be really careful with that. Is there any questions on this one at all? All right, so we will move on. So some additional considerations. You must use the higher of the year-to-date calculation versus the hourly calculation. So in our previous slide, let's take a look. Say this is the person that we were looking at. So their hourly is 28,000 and their annualized is 25,000. So you would obviously use the higher of. If it's a big difference between the two, you'll definitely want to find out why, because that's going to be our first question. Why is there such a big difference? Was there tips included in the year to date and it wasn't included in the other? Because there's obviously, they should be pretty close. And then you're going to use the highest hours per week when a range is given. Like I was saying before, on the employment verification, they say 32 to 35 hours a week. You're going to want to use the 35 hours a week. If it makes them over, then you can do a phone clarification with the third party and get clarification if they have a specific amount of hours that they work. Other than that, you're just going to have to use the higher of. Oh, and look at there. If that overqualifies the household, obtain additional written clarification from the employer. And you're going to want to include the anticipated raises, tips, bonuses, commission, and any other kind of pay. So these may or may not be included in the year to date. So on our form, it does ask if it's included in the year to date. So you'll definitely want to look and see if it's checked yes or no down there. And if it's checked no, then you're going to want to add that to the year to date number up above. And sometimes there may be 0 in the bonus or the tips, and you know that it's a server and usually they make tips. So you can ask more questions if it doesn't make sense to you. And if there is no tip income and the employer does not want to disclose it, we came up with a 20% of the annual income. We want you to add on 20% for gratuities. So that's for the service industry, taxis, salons, servers. If it's the gaming industry, meaning casinos, and we're talking about the server or the blackjack dealer. We're not talking about the custodian or the security guard. They're not going to get tips. So, and then you're going to want to show your work and all the different calculations you've used, because we want to see how you came up with the number that you came up with. And then if it's a site employee and they're not in a common area unit, We must include any rent concessions they get. So if it's a key holder that just gets maybe $100 off of their rent a month, you're going to want to make sure to count that as income and get the third-party verification as well. And if they're employed by their family, it's a family member employer, you're going to want to have them provide at least one pay stub, one of the newest pay stubs, of course, in addition to the verification. It's just a double check, just making sure you do your due diligence. All right, do we have any questions on this at all? Boy, I feel like we're just cruising right through this. So calculating seasonal income. So this is someone who works seasonal at different companies. You're gonna want to calculate their wages plus unemployment. So again, like I was saying in the part-time hours before, if they don't work 52 weeks at that employer, you're going to want to find out what they're doing during the rest of the time. They may get unemployment or they may not. You're going to want to include all sources of income for the full 12 months. And again, if they don't have income for 12 months, please let us know the weeks that they don't have any employment. What are they going to do for income? Or how are they going to pay the rent, I should say. And then see the seasonal worker statement. That will walk you through how to be able to get some of the information that you need. All right, now we're going to take a look at business income. So someone is self-employed. So you're going to have them complete the self-employment verification form. And the resident's going to submit the most recent entire signed tax return. I want to reiterate, signed tax return. If it's not signed, then you want to have the page that shows that it was e-filed by their accountant or whatever entity. If they do it themselves, you want to have that form as well. And the 1040 usually gets generated if anyone makes $400 or more. So if someone's been self-employed for a couple of years and they say they don't have a tax return, you might want to question them a little bit farther. Then you might want to remind them, this is an IRS property. So I know you can't make them do one, but so when you do get the 1040, you're going to want to get the Schedule C, D, and or F. And if they happen to have Schedule K1 as well. And as you all know, the IRS forms have been changing. So if there's been one added, please do your due diligence and make sure that you get all the forms that show what income and expenses that they've taken. If they haven't done a tax return yet, their self-employment is new, they can do a profit and loss. The profit and loss is very simple. We'll go over that here in just a minute. We don't expect really a lot of detail on that one. So request further documentation from the resident when you have any questions. And then you want to have them complete and submit the self-employment income worksheet. And you're going to use the net from the income from the business because they can take out their expenses. And if the business income is negative, you're going to want to make it a 0. We do not do negatives. We do 0 or greater. All right, so here's a quick look at a very simple profit and loss. Like I said, we don't expect too much on this one. We do want every month put up on the top and then a yearly total on the right-hand side. And then we want the income that they're going to generate and then the expenses. And then at the very bottom, it's going to give them the total sales. And this is going to be the revenue minus the expenses is going to be this. And so this is the number here that we're going to use. This is the yearly. This is their yearly income minus their yearly expenses. So it's going to they made 1,218, but they're only going to have to claim 503 because they spent 715 on expenses.
One thing I'd like to point out about the business, the profit and loss statement, be sure that the expenses they're putting down are relevant. For instance,
Right.
I had a property where a gentleman owned a landscape company, and part of his expenses was lunch because he couldn't make it back home to have lunch. It didn't really seem relevant to the industry for me.
Right. And that's a very good point, Dwayne, because sometimes, you see that someone makes, 20,000 at a company that they own, and they have $21,000 in expenses every year. I mean, I don't know about you, but I think I would want my company to be making a little bit of money.
Sure.
Well, and you can certainly ask questions about it. I mean, you're not the IRS, so what they choose to put to the IRS is what they
True.
choose to do, but you could certainly ask questions about things that look like they just don't make sense.
Right. Because we don't want you guys to be an accountant. I mean, that's up to the accounting department to be able to do their taxes. You just want to get clarification of why, So we're going to look at an example of a Schedule C. And this is the expenses part. And these are a couple areas that you might want to look at. Oh, okay, so here's the net profit and loss. This is going to be where that 551, I think it was from the other side, that's where this would normally be. So for instance, up here, if there's wages, you're going to want to ask, who are those wages paid to? Were they paid to anyone in the household? Because if they were, you're going to look at that a little differently. You might have to add it back in or take it out. Contract labor, same question. Who was it paid to? Depletion, you're going to take that amount and add that back in with the net. That's not an expense that can be taken. And also depreciation. You want to add that back to the net as well. And then you're going to want to look at the other expenses. Are they reasonable? And you're going to review it against additional pages because normally that's on another page. And again, we don't expect you to be an accountant, but if something is kind of a red flag to you, please let us know what the explanation is, because it's going to be a red flag to us as well. Is there any questions on self-employment at all?
Well, there was one, let's see. Generally in the past for new self-employment people, I have not counted any deductions unless they are over income. Then I will ask them about deductions and let them know we need the supporting documentation.
So they are getting the documentation though.
Right. I think that's related to Lyft, Uber, or DoorDash. I've typically gotten the app income.
Oh, okay.
That, so
yeah,
okay.
and that's totally acceptable. I mean, if you use the gross amount and they qualify, why do the math on the rest? If they qualify with that and you have the backup for it, that's fine. If it makes them over income, well, yeah, then that might be a moment that you might want to stop and take out the expenses. Okay, so Social Security, SSI, SSDI. So you're going to verify and you're going to count all anticipated benefits, including anticipated start of the Social Security, SSI, or survivor benefits. So meaning that if someone is of age to claim Social Security and they say they are going to, then you're going to want to dive a little bit deeper into that one. We'll go into that here in just a few minutes. You must obtain the most current statement and always use the gross amount or gross income before any deductions. So it's the top number, the amount that they're going to receive. Whatever they pay and anything else, that's not going to be taken out of this number. You're going to use the gross. And if there's delayed Social Security, SSI payments, those are not going to be counted as income because that's going to be a one-time payment. And they didn't know that it was going to be coming, If they do put it in their checking account, well, yeah, then it'll be counted as an asset. So Social Security or SSI recipients may also receive a $40 supplemental, which is verified through DSHS. We found out that this year, that dollar figure is actually going down. It's going down to 38.25. I don't know, I'm not sure exactly why. I think this is the first time in years. It's always been $40. So, but we wanted to let you know that we did find that out. And any garnishments that are on there are not going to be deducted either. And then you're going to count the amount after overpayment has been deducted with the documentation that it'll be greater than 12 months. Meaning that if they were overpaid and the Social Security is collecting it back on each one of their on each one of their checks, you're going to want to make sure that they still have 12 months worth of that to be able to count the lower of. That would be the only time that we would go the lower of. And then you want to be on the watch for the cost of living adjustments, the COLA. For 2021, we did hear it's going to be 1.3. It was released in October of 2020. And so I believe the letters come out in December. And they can go to this website here to be able to find out what their next year's Social Security will be if the letter has already been released. So here's a copy of the letter. We will accept this letter for the full year of 2020. It doesn't have to be within that 120 days because this is Social Security is the only reason we ever waive that. So as you can see, it tells you how much they're going to be making each month. So $910.50. And then there's this benefit letter. And we will accept this one again for the whole year of 2020 as well. And again, we always want the gross. So you're going to take this top number here. Well, I guess we have a polling question.
So here's another polling question. If an applicant anticipates Social Security income on their application, but benefits have not been awarded yet, do we still have to verify and count the income? This is a pretty easy one. Yes or no, you got a 50-50 chance.
It looks like everyone answered yes. And so that is the correct answer. So please be aware that if someone states on their REA or income assets that they are applying for Social Security SSI benefits within the next 12 months, you must attempt to verify what those future benefits might be. So there's in the FAQs, this is a snipping from the bond compliance frequently asked questions. So as you can see, there's quite the answers. Dwayne, did you want to read it?
Oh, sure. I'm sorry.
No, that's okay.
If an applicant anticipates Social Security income on their application, but benefits have not been awarded, do we still have to verify and count the income? Answer. Please be aware that if someone states on their REA or income asset form that they are applying for SS or SSI benefits within the next 12 months, you must attempt to verify what those future benefits might be. Number one, when someone indicates they have or will be applying, you need to ask them when they expect to receive it, how much they expect to receive, and document this in the file. If they know they will be receiving Social Security or SSI benefits of any kind in the near future, then you must count that income. Number two, if they are of retirement age and have applied or plan on applying within the next 12 months, then you must have them go to the Social Security website at this address and use the benefits estimator and estimate their benefit income. If they've applied for Social Security disability, you need to ask them if they have received anything back from SSI. If so, request a copy to see the status on their claim. If they have not been denied, then you must assume that they'll be getting the full SSI appeal. If so, request anything that they have showing the status of that appeal. If there's no conclusive documentation that they may win the appeal, then you do not need to assume any SSI benefits. If they have an attorney working on the appeal for them, you should request a statement from the attorney regarding the status of the appeal and likelihood that SSI will be obtained and at what amount, and count this accordingly. If they indicated that they will be applying for SSI disability benefits, you do not need to count any, as this process usually takes several months or longer before benefits are awarded. And number 4, if the household has immigrated or are refugees and applied or plans on applying for SSI, you must assume that they'll be getting the full SSI benefit as income for the next 12 months. And please note, an applicant who is widowed or divorced may be eligible to receive the higher of their own SS benefit amount or that of their deceased or ex-spouse. Therefore, if an applicant is recently widowed or divorced, their SS benefit may increase.
So again, this is in our frequently asked questions. This is not on your slide presentation that we sent you. So definitely go and look at the frequently asked questions. And all right, so was there any questions regarding Social Security, SSI, any of those? All right, it appears we are clear. Okay, so income verification. So child support payments. You must count the amount from the court order. Unless the applicant certifies payments are not being made and all reasonable legal actions to collect the amounts due, including filing with the appropriate courts or agencies responsible for enforcing these payments. And you're only going to count what the resident receives. So if they say they're supposed to receive a certain amount and they're not receiving that, and it's been a habit, then you'll want them to fill out a child support enforcement verification. You would also like to look at the court order and review the entire divorce decree. It's pretty amazing when you read that divorce decree, what all, especially if it's a newer one, there may be spouse payments in there. It's sometimes can be an eye opener, and sometimes it's just as what they had said. So the child support affidavit, if they fill that out, there's on there, they could also, this is the place that they can tell you if they're not going to be getting the amounts that that the court order says, and this would have to be notarized as well. All right, is there any other questions regarding child support? A lot of times, I want to say, is that DSHS, that form that we normally get, you guys?
Yes.
I'm used to seeing the form, and that's a really good one to get because it shows how much they're supposed to be getting from the spouse and or the parent. And it also shows what they have been receiving. And if there's any payments that are going to say DSHS, or if they're getting any back support. So that definitely is a form that's really user-friendly. I don't think we have a copy of it in our program here, but all right, so spousal support and alimony payments. So income or assets being given to the household. You're going to want to look at the divorce decree and review the entire divorce decree. Again, in here, it may say that they have ownership of 50% of a house, but maybe they are not living in the house right now, so they didn't declare it on their REA. And then, of course, at that time, it opens up discussions. You'll want a notarized gift affidavit from the giver of any alimony that's received, or you can get a notarized gift affidavit from the receiver if the giver is not wanting to do that. All right, so now we're going to move into gifts from family, friends, support, churches. So any kind of cash contribution to the household that's from an outside source. So for instance, like I was talking about that dad who bought the gas for their child, that's considered a gift because it's every month. Non-cash contribution to the household from an outside source. So for example, gas, insurance, cell phone, personal items, etc. And then funds from private sources, including direct rental payments from family, friends, churches, etc. Again, you might want to be really careful with that, because sometimes when people get rental assistance from an outside source, it might be coming from a different agency, but it could be actually the funding itself could be from the government. And if that's the case, that wouldn't be counted. So you'll definitely want to find out where that money is coming from. If it's just from a private source, then yes, you definitely want to count it. But if you find out that that agency is actually getting it from the federal government, then you'll want to make sure to document it and maybe contact your portfolio analyst if you have any other questions. So you're never going to count the value of food or groceries that are given to the household. So say your mother went grocery shopping and brought you a carload of food. You're not going to count that. But if she gives you $50 a week for grocery shopping, you will count that. That will be a gift. So childcare payments that are paid directly to the childcare provider, those are not going to be counted. And federal, state, and local government rental assistance funds such as HUD, RD, Section 8, Home, HEN, anything that's coming from the federal, state, and local government. And then you're always going to want to get the gift affidavit notarized. All right, I'm hearing no questions. We're cruising right along. You guys have anything to add? No?
I don't.
Okay, so types of payments in lieu of earnings. All right, so there's unemployment, disability compensation, or workers' compensation. This must be annualized. So for instance, you know, unemployment only goes for a certain amount of time, but it can be extended. So you always want to take unemployment and annualize it. Unless you know that they're going to be going back to work on a certain day and it's documented. Other than that, take their unemployment, disability, workers' comp, and you're going to times that times 12, or however you figure out the annualization, because they can be renewed. And then you're going to want to verify with the third-party verification or the benefit statement. So for instance, on unemployment, they can send you the amounts that they've been sending to the unemployed person. And you want to put that in the file. So unearned income such as DSHS. So cash assistance is counted as income. So that's TANF, the temporary assistance for needy families. The refugee cash assistance, general assistance, age, blind, disabled assistance. The basic food allowance is never counted as income. And so TANF, DSHS recipients receive benefits on a cash card. So you're gonna, for assets, you're gonna wanna make sure to get the balance of what is on that cash card. They don't necessarily have to have a checking or savings account. All right, so earned income, pensions, retirement, VA benefits, IRA, 401k, annuities. If the household is receiving periodic payments, it's going to be income, meaning that it's known. It's going to be coming every month. Appropriate verification forms. So for instance, on this one, you just need to get the verification form from where they're receiving those payments from. And you're going to want to get the most current benefit statement. You don't want one from last year. You want it from, hopefully they come every quarter sometimes. So it's going to have to be the most current. And VA follows the Social Security COLA. So you'll want to make sure that that gets adjusted accordingly. And if there's no periodic payments, you're going to take that asset and you're going to value it as an asset. Oh, okay. sorry, this kind of went a little funny. Pension retirement, you're going to want a current letter on that. And then the IRA or annuities, you're going to want a current statement. All right. So student financial assistance. So for tax credit programs, student financial assistance is excluded from the household income unless the household is receiving Section 8 or USDA RD assistance. Then you must count the student financial assistance received by all students, except the adult students who are 20 or over 23 and have a dependent child. It's always funny. There's always an exception. Okay, and adult students who are dependents of the household. So if the parents are living in the household with the child. Oh, all right. And there's no questions on this. So we're going to move into military pay. So we're going to understand the LES. What do you count? Okay, so all regular pay, special pay, and allowances. So military basic, the BAH, BAS, the clothing allowance, and other special allowances. You're not going to count the hostile fire or imminent danger pay or any re-enlistment bonuses. So the basic allowance for housing, the BAH, is excluded at properties in the following counties that were placed in service after 7/30/2008. And that would be Kitsap, Mason, Jefferson, Pierce, King, Island, and Snohomish. BAH must be included in income calculations at properties in these counties that are placed in service before 7/30/2008 and at all properties in all other counties in the state of Washington. All right, so now we're going to look at how do we look at an LES. So in the square, this is the entitlements. These are the different kinds of pay that they get. For instance, as you can see, there's base pay, BAS, BAH, fly pay. You're going to take the grand total down at the bottom. It's a little blurry. Sorry about that. And then to get there, there's 3 different things that you're going to want to know to be able to figure out, I believe it's a clothing allowance, the grade, the years of service, the branch that they're in, and then I believe this is the dependent status. And military compensation website, militarypay.defense.gov. This pay and clothing allowance chart is available based on the branch. Oh, it's also the pay. Sorry, I thought it was just clothing. The pay, or sorry, the branch, the grade, and years of service. And the BAH chart is available by zip code and dependent status. Any questions about?
One thing I'd like to add is be sure that the LES statement is from their current paying station. I had a property several years ago where a family had moved up here from Florida, and they used the LES statement from Florida, which was lower income than here in Washington. And it amounted to the household being overqualified at move-in. So just be aware of where their paying station is on the LES. Astrid, you can unmute yourself and ask a question now.
Hi. So I just moved in people that had one of the spouses had military income. And I just want to make sure that I did it correctly, because I took this bottom total. I don't know why I'm pointing. You can't see what I'm talking about. That the center pay, the base pay, and it has all those deductions on it. And there's a bottom total there.
Uh-huh.
That's what I used, but we circled some other things here, and I'm wondering, was I supposed to go to militarypay.defense.gov to look up what those meant and then do further deductions from what that base number at the bottom was?
No, I think this was just in case you wanted to, you could find it yourself if you had that information.
Okay, so as long as I used whatever
Their current one?
they're all current, but as long as I just took from that center part, it has a total of what their income is, where they get it paid monthly, then that's fine.
Yes, I believe so.
Thank you.
Eric, did you have something? Okay, Eric, I will unmute you. Go ahead and unmute, Eric.
So on the military pay, you would use what that total is down at the bottom. What this page is showing you is if you have a military family that is moving from out of the area to the local area, and you don't know what their pay is going to be in this area because their pay is based upon where they're stationed, you can look at their LES. And if you look at these 4 different areas, area 3 is grade, years of service, their branch of service, and number 51, I don't remember what that means, but they'll
I think it
have
was the dependent status, isn't it?
dependent status. Yes. If you have those 4 things and their location, so I think it's the zip code, and you go to militarypay.defense.gov, you can put in those 4 things and their zip code, and it will tell you what their pay is going to be.
All right. Thank you, Eric. All right. Great questions. Thank you. All right. So we will move on. Oops, sorry. There we go. Okay. So real estate. So real estate producing income is a rental, and you're going to count the rental income as income. If the real estate is not producing income, it's going to be an asset, and you're going to want to see the asset valuation form or fill it out. All right, so determining rental income. So to determine the annual rental payment, you'll want to get a copy of the resident's lease. And then you're going to want to minus the mortgage interest payment that they're making, just the interest, not the principal. All right, so you'll want to get a mortgage statement to be able to get that number. Of course, that's going to be, you're going to want to get a recent one. You're also going to minus any other allowable expenses, like if the owner pays the utilities, the insurance on the property, taxes, anything that's keeping the house up. So you're going to ask the owner to supply an expense statement. And then preferred verification is a copy of the resident signed tax return, the 1040, with the Schedule E, and a copy of the lease. Oops. Now, if they own real estate, but they're not renting it, you want to find out what their plan is. Okay. You just want to know, a lot of times people aren't just going to leave their rental property just sitting there. They're going to either rent it. Maybe they have a family member that's living in there and they're not charging them rent. You want to find out, just dig a little bit deeper. Okay, so zero income. Sorry about that. So zero income certification. So if a resident of the household does not have a job or does not have any kind of income whatsoever, you're going to want them to fill out this form. And the one thing you're going to want to do is question number 3, it's saying what following sources of funds they're going to use to pay rent and other necessities. You're going to want them to put the individual's name, not mom, dad, because we want to make sure that that other person lives in that household. Because if they don't live in the household, then that's going to be gift income. So definitely make sure to get the source's full name. Oh, Dwayne, there's some polling questions.
Oh, Shauna, I've got a polling question. Can we use documentation provided by the applicant resident to verify income? Your options are yes, no, or I don't know.
All right, so we have 67% said yes, and that is correct. So the printed statements from the state, oh, I'll share the results with everybody. Printed statements from the state or federal agencies may be used to verify income as long as they are current within 120 days of the certification date and provide all the necessary information. We will accept statements or printouts from Social Security beyond 120 days that show the set gross benefit for the current year. It says no, and that is correct. The commission confirmed that all funds go directly to the landlord or the utility company. The recipient does not receive a cash benefit, and the recipient does not have to report this assistance to the IRS. All right.